Ginzo VI! Onegai shimasu!
Hello everyone, welcome to another video on the Value Investing Toolkit series. In this video, we're going to go through my buying decision process and how I manage my portfolio. More specifically, we're going to have a look at what I call my code of honor or my investing bushido. We're also going to have a look at the techniques that I use to try to mitigate risk, mainly by diversification, and also what are my thoughts about the number of stocks, how big should be your portfolio. Also, we're going to discuss what kind of decisions I take on when I pull the trigger for buying a stock. I'm going to tell you about my own valuation and what kind of technique I use to check my confidence level on that valuation, and then based on that I kind of derive my margin of safety. And then last but not least, I'm going to kind of share my thoughts and how you need to keep an eye open for the businesses that you own, meaning the businesses that you invest in. Okay, so it's very, very important to keep our eyes open and keep track of the news, what's going on a quarterly basis, see how the company is performing, and so forth and so on. All right, let's do this then. Okay, my investment code of honor, or my bushido. I have a set of rules that I use, that I follow on my investments. The first one is that I only invest in companies that are based or domiciled in stable economies, and where there is political freedom and where there's a trustable rule of law. Okay, so that's, you may think that in the US, that's the case. I agree with you, but a lot of the stocks that investors are drawn more recently, they're in geographies or countries where there's not a lot of trust in the rule of law. There's not a lot of political freedom, and actually the earnings of those companies and the sheer existing of those companies can be at risk in some of those countries. So I take a particular interest only to invest in countries that have stable economies, political freedom, and trustable rule of law. Then my second rule on the code of honor is I only invest in companies with a high percentage of float. This means that high percentage of float is the percentage of shares in the company that are available to be traded on the open market. Okay, so there's a few companies out there, not a lot, but there's still a few companies where a big chunk of the company is still owned either by the government or by a larger company. So I'll just give you an example on an area that I know about. Historically, or in the last couple of years, there's been a trend on utilities kind of spawning a subsidiary for renewables and then putting out a small percentage, say 30%, 40% of that renewable subsidiary company in the market, but they still retain 55 to 60, maybe even sometimes 70% of the stocks for themselves. I don't like to invest in those sort of companies. I like to invest in companies where the percentage of float is extremely high, above 90%, meaning that at least 90% of the shares of the company can be traded in the exchanges. I mean, I personally don't like this. There's some history of those big companies that have 60% of another company having some control, and there's also some dodgy business of moving assets back and forth between those companies, and the shareholder gets the last straw of it. And I don't like to invest in that sort of company. So as a rule of thumb, I only invest in companies with a very high percentage of float, 90% above. I also avoid companies with large state ownership. Okay. Personally, I think a state ownership is always a lag in a company. It also kind of makes the company vulnerable, saying my words right, to dodgy businesses, and having government officials taking positions with those in those companies without having the right qualification or the knowledge to be on the board of directors, and so forth and so on. So I avoid companies where there's a large state ownership at stake. Then the next one is, my next rule is about avoiding companies in the military sector. Okay, and when I say avoid, I mean it's subject to my own decision. Okay. When I say avoid, because there are some companies which are not directly in the military sector. So there are companies out there that build engines to military aircraft. There are companies out there that actually build the nuclear reactors that power the aircrafters. So yeah, I'm more than happy to invest in those companies. I just avoid companies that their sole purpose is the military sector. Okay, that's my personal preference. I have nothing against people who invest in this type of companies. That's my own personal decision. Okay. The next one is I avoid companies in the gambling sector. Okay, again, this is my personal preference. I don't want to go too deep into this. I don't want to create any kind of discussions on this. It's just my preference. I avoid companies that work mostly in the gambling sector. And then the next rule is about companies in the carbon emission intensive industry. Again, I avoid them. It doesn't mean that I'm not going to invest in a company that is somewhat related to carbon emissions. I just prefer to look forward into the future and invest in other types of companies. Again, my own preference on this one. And then last but not least, I will never make an investment in any company with any association with child labor, human traffic, slavery, sexual orientation, or gender discrimination. Okay, absolutely. This is a golden rule for me. I will not invest in any company that has any sort of associations with the things I've just mentioned. Okay, so my own investment code of honor. Your code of honor, your Bushido may be different. I do advise you to have one, just to kind of have a guideline for the companies that you want to avoid. You can take mine as an example and build your own. You can scrap mine and just create one of your own. It's up to you. Right, so the next thing I want to talk to you about is risk mitigation and diversification. Okay, so there's some portfolio theories out there that say that the more diversified you are in your portfolio, the lower your risk is. And yes, that is somewhat correct. There's a small twist to it, in that when you diversify, you should diversify into uncorrelated assets. Okay, what do I mean by this? I mean that it's not enough to have shares in 20 or 30 stocks, it's important that those stocks, okay, and I'm not saying that 20 or 30 is the right number. I'm just saying that if you have a number of stocks, that yes, you should diversify, but when you diversify, you have to take into consideration how correlated or uncorrelated those stocks are. I'll just give you an example. Usually an example is much simpler to understand. If you invest in, say, 5 companies, and all those 5 companies are located in the US, and all those 5 companies are, software companies that, sell enterprise software, all those 5s, you're not really diversifying. Yes, you're investing in 5 different businesses, but they all from the same country, they all from the same sector, they all from the same industry. If something goes wrong in that industry, in that country, in that sector, all those investments will be affected. Okay, so take that into consideration. When you diversify, you should be looking at, as much as possible, uncorrelated assets or uncorrelated stocks. So you could, for example, invest in one software company in the US, another software company in Europe, and then another, mining company in Australia, and another, consumer product company in South America, and so forth and so on. So try to diversify, but into an uncorrelated portfolio. Okay. So I try to do that on my own investing. Okay. So the way I do that, I try to make it simple, as I mentioned in the example. I kind of create a list of relationships that two companies may have. So the relationships would be the country they're located, the region, the industry, the sector, if they have a client-supplier relationship, so if one company is supplier or client of the other, customer sharing, do they share customers, do they share suppliers, do they have cross ownerships, does one company owns part of the other, and do they also are they direct competitors? Okay, so each time 2 companies have the same relationship on any of these items on the list, I count as one. So if one company, if there is 2 companies which are based on the same country, the same region, the same industry, that counts as 3 points, 3 relationships, and so forth and so on. So again, just to give you an example, I have a list of companies that I'll probably do a video on each one of them at a later stage, but that I've valued and validated, and it's on my list, on my watch list. So these are companies that I may or may not invest in the near future. And then I've created in the bottom, I've created a relationship matrix between all the pairs of those companies. Okay, and when they share any of those relationships, I just add 1 to their cell in the matrix. So for example, Intel has a relationship of 2, or they share 2 relationships with Berkshire. They share 4 relationships with AMAT, as well as with TER. Okay, and 2 relationships with LMT, and 1 relationship with SAP. Okay, and so forth and so on. Right. So the idea here is that when I'm building my portfolio, out of those companies that I already validated and evaluated, I can choose the ones that would, are less correlated, so to say. Okay. So, and then the next thing I do is I want to try to keep my portfolio manageable. Okay, so we see a lot of videos with a lot of portfolios from the gurus and from investing companies who have hundreds, sometimes thousands of shares. I mean, it's difficult enough for me to manage 10 stocks and keep track of all those 10 stocks, let alone hundreds of thousands of them. So, and I fully agree with what Warren Buffett and Charlie Munger say when the less you have, the more. If you can invest in 3 or 5 or 10 great stocks, why would you invest in 200? Why would you invest in 1,000, right? If you really find 5, 10 great businesses, invest in those. That's it. That's all you need, right? Again, if you find 5 or 10 great uncorrelated businesses, that's all you need. Okay, and that's all I need. I keep my portfolio to 5 stocks on average. Sometimes I go a little bit above when I see some opportunities out there, but on average, my portfolio has 5, 6, 7 stocks. That's it. The second way I try to mitigate risk is by having a margin of safety. Okay, and that margin of safety is on my valuation. So I've showed you in the previous video how I calculate the intrinsic value of a business. And as you can see here, I have this list of businesses which I have already calculated their intrinsic value over here. Okay, that's my valuation of the intrinsic value, and I want to have some sort of idea of how right am I? I will always be wrong on my valuation, right? But I'm interested to know how much can I be wrong. Okay, so what I do is I compare my valuation method with Professor Damodaran valuation spreadsheet. So I do my own valuation. I use the Professor Damodaran spreadsheet to calculate another valuation using a different method, and then I compare both of them. Okay, and when I compare, there's a difference right here, and you can see there on the third column where it says diff valuation. That's the difference between my valuation and the valuation I get when using Professor Damodaran's spreadsheet. Okay, and I look at that difference and I come up with the level of confidence that I have on my valuation. Okay, and the level of confidence can go as high as 80%. I'm 80% confident in my valuation, that my valuation reflects the intrinsic value of the business based on my assumptions, and then the lowest it can go is like 50%, 40%, right? If there is too big of a difference. If there is too big of a difference, it's probably because I made a mistake somewhere. So I'll try to recalculate and go back and trace back my valuation to see where what I did wrong. Right? Usually, the differences I get from my valuation and Professor Damodaran's spreadsheet is between 10, 15. Sometimes, as you see here on the Royal Gold, it goes up to 56%, and hence why my level of confidence is 60%. Okay. So what I do then is that I use my level of confidence to come up with my margin of safety. So for example, if I have a level of confidence in my valuation of 70%, then my margin of safety will be 30%. If instead my level of confidence is only 60%, then my required margin of safety is going to be higher. It's going to be 40%. Okay, and what you see here on the right hand side, margin of safety, is exactly those numbers. And when you see a green cell, visually it tells me that the price today is above my margin of safety. So, in other words, it would be a good buy, right? I would be buying this stock if the price was above my margin of safety. Okay. And then, you just have to wait for it. You just have to keep an eye on this margin of safety. In my case, I keep an eye on this spreadsheet. By the way, the spreadsheet with my watch list will be available soon for you guys to have a play with and use it yourselves if you want. So we just need to keep calm. This is part of being a value investor, is just keep cool heads, have patience, and wait until you get the stock that you want at a price that reflects the margin of safety that you'd be confident on buying the stock. Okay, just keep calm and wait for it. Right. And then last but not least, keep an eye on our business, sleeping with an eye open, as they say. So once we make the decision of buying a stock, and we get that in our portfolio, we need to keep an eye on our business now, right? If you buy a stock, don't forget, when you're buying a stock as a value investing, you are owning a portion of the business. So at the end of the day, it is also your business. So you need to keep an eye on your businesses, right? And it's crazy how things can change very, very quickly, okay? So I'll just give you an example on the recent 2020 pandemic. I mean, back in December, November 2019, no one was expecting this. So, just see what happened with the number of flights in the first quarter of 2020. It just came crashing down. It was crazy. We know a lot of money was lost. A lot of airlines are losing money by the day. A lot of companies, a lot of businesses around the airline industry have been losing money, have been decreasing revenues. So this is something that we need to be very, very aware. Things can change, and things do change, and they can change quite rapidly. Okay. Other things that you need to keep an eye on is on the news, on the stocks that you own, but also on the stocks that you have on your watch list. Okay. So there are occasions where a business or a sector or an industry is affected by an event. Just to give you some examples, in 2019 there was a big disaster in Brazil when the dam from the company Vale collapsed, and it killed hundreds of people, and Vale actually was fined, and they had to pay 7 billion in compensations for that disaster. And that's not the only disaster that happened with this company. I believe in 2015 something very similar happened. So these sort of things we need to keep an eye on. Another example is the recent situation in Turkey, where the standing president fired the Turkish Fed president, which brought the entire stock markets and the Turkish lira coming down massively in a couple of days, right? So again, going back to one of my initial points, be very, very wary on investing in countries where there's a lot of politics involved, and there's a lot of government, business, meddling, just to say nothing worse. Anyway, the same thing with the recent crackdown on China's Alibaba and other companies. And last but not least, especially for the businesses that you own, keep an eye on what management is doing, and keep an eye on how management is using the shareholders' money. Okay, you have situations where sometimes the CEO is just behaving in a way which is not, morally accepted, right? And using shareholders and company money for things that it shouldn't. Okay, not going to mention name, it's in the slide. Okay, an example. All right, so I think that was all for today. So in this series so far, we covered how we screen for value. We also have a video on the financials and how to financially analyze a business. Another video on business validation, how I validate a company. I've also done a video on how I value a business, come up with an intrinsic value for the business. And in this video, we covered buying decisions and how I manage my portfolio. Okay. In the next video, the last of the series, I'm going to talk about what kind of decision process I take when selling a stock, and also other considerations about value investing. So I hope you like this type of videos, and I hope you like this type of content. If you do, please give me a thumbs up. That will let me know that there's people out there that value this sort of information, and I'll keep on doing those videos. Okay. Also, if you want to be notified on the upcoming video, please click the subscribe button and the bell icon, and you'll get a notification when I upload the next video. So thank you very much, and that's all for now, and stay safe out there.
Kinzo viai! Arigatou gozaimashita!